I think investor confidence has really been shattered because we've had so many 1,000-point swings. I mean, the market's been lurching. But I think the White House moves yesterday and the move in interest rates back above 0.5% and the 30-year back above 1% are things that maybe give you a sense that crisis levels have dropped from, 10 plus to 9. So I think in a way it's moving in the right direction.
But still, the 10-year at 0.73%. I mean, that is incredibly low, or the 30-year just above 1%.
Yeah, it's unimaginable that the U.S. is trending towards interest rates that we've seen in countries that have had emergency interest rates, right? So I think that really highlights how scared and how dangerous markets have become and, the threat posed by Corona.
And so if we get some fiscal stimulus measures, as President Trump is suggesting that we will today, will that help? Will that stabilize things from an economic or a market standpoint, or is that not enough?
I think it's a big deal. Because if you're managing money and you think Corona is going to take 6 to 8 weeks to play out, and that's what the VIX futures markets is pricing in, it's pricing in a lot of volatility through May, then you need something that will give you confidence to keep your money and assets invested. And I think fiscal is a good way to tide this over, because if we have, 1 or 2 quarters of fiscal support plus the central banks providing liquidity, it helps us get through this, what could be a speed bump or it could be a recession.
The markets are really pricing in further Fed cuts. But that didn't really do much when we had the surprise Fed cut of those 50 basis points. So is that necessary? Do we need it? Should they do it?
Yeah, I'm in the camp that, the Fed needs to respond to what is happening in the rates markets. And there's a lot of pressure because before the emergency cut, the front end rates were actually higher than long-term rates. So we had a huge amount of inversion in the yield curve. And that emergency cut largely addressed it. So 90% of the curve is fixed. So I think it made sense, not from trying to stimulate the economy, but to prevent plumbing from getting worse.
And so I'm going to ask you one more question before we have to move on, but I know you're going to stick with us. So we saw a lot of action yesterday in the oil market. Yes, we're seeing a rebound here today by about 5.5%, but still, WTI under 33. We're hearing sort of this profitability point for many U.S. producers is around 50. I mean, how closely correlated do we need to be watching both the market in oil and then the broader market for equities globally and otherwise?
Yeah. Well, the drop in oil is a disaster economically because, if you think about just credit, for instance, 11% of the high yield market is oil. So we saw a huge widening of spreads there, and it exposes the banks. That's why the banks and energy have really been the most toxic groups. And yeah, it's a problem globally because 40% of global GDP is produced by countries that produce commodities. So if oil's tanking, it's putting a lot of the world in a depression.